Welcome back, everybody. Sorry, I've been away for a couple of weeks. I actually hadn't been on holiday nor been ill. So thank you, everyone, for the well wishes and the cards. But I've been waiting for something good to turn up, and this is it. So we don't just put a show on for nothing. This has got to be a launch or something special. So I'm delighted to have friends of the show here. Today, there will be no mention of HS2, you'll be pleased to know. This is going to be totally different. So goodbye Yellow Brick Road to HS2. And this is going to be totally different. We've never been anywhere like this before. So what I want to do is pass across to my good friend Paul Preston, who's going to tell us a little bit about what you've got.
Thanks very much, Chris. Yeah, so we've been in the residential market now for the last sort of 15 years. And a lot of the focus has been on just normal residential city centre where there's a bit of value. But obviously, in any asset class, you're always trying to look for a slightly different approach, some potential, some things that are quite new into the market. So we've been working quite hard, myself, Jake and Reese, over the last couple of years, just to look at still residential property, but areas within that sector that have not seen sort of the growth or the opportunity that general city centre stock has seen. So today, myself and Jake are going to talk to you about the first project, which is in Sidmouth in Devon. It's a staycation product, a very high net yield. The staycation market in the UK is booming. Currently, we expect that will be the same for the next sort of 4 to 5 years, given all the reports and everything that we're reading. So I'm very excited about that particular project. And then also we've delved into the social housing market. Now, social housing here in the UK generally has always been only available to large institutes, so pension funds, hedge funds. They've been big buyers of this asset class just because the strength of the lease, these contracts that people are buying into are effectively government contracts, minimum of 5-year leases. So we've been working hard again over the last sort of 12 months to make that product available in retail format for our individual clients. So we're really excited about this. We launched our first scheme here a couple of weeks ago. 25 units sold very quickly. The entry level into this is sort of starting at £70,000. Again, you've got a minimum of a 5-year government-backed lease, and the net yields on this are over 7%. So no additional cost to their ground rent, service charge, etc. There's none of that due to it being social housing, and again the contract effectively with the government, which is the housing association. So two things that are very different. Again, this is the first one that Jake will talk through. It's very difficult to access the right kind of product in this sector. So effectively what we've done here is we've found a developer that's been doing this for 20 years. They've got a huge land bank. We launched our first project in this sector around 3 months ago, sold very, very quickly. All UK investors, actually. We've not launched this product offshore yet in the Middle East or Asia. But there's a huge demand for it. And I think what people are realising for the first time, because of COVID, they can't go away. And they're just realising there's some absolutely stunning places in the UK that they would never normally go to, because there'd be Middle East, Spain, Maldives, wherever. But that opportunity has not been there for them. So people that want to go away on holiday, they've had to stay in the UK because of COVID. And again, the reports that we're reading, these people now, their whole mindset has changed. If they can jump in the car with their dog for 3 hours and the family without getting on a plane, your COVID tests, etc. It's just really accessible. And again, it's an area of the market which we've thankfully got a very strong pipeline in, and one that we're excited to sort of focus on for the next few years, just because of the demand from a tenant aspect here. It's just gone through the roof over the last couple of years. So yeah, I'll let Jake go through this potential sector, and then we'll dovetail throughout the rest of the presentation.
Perfect. Thanks, Paul. So just going to start with a bit about why the UK staycation market, and really just highlighting some of the news articles that I'm sure many of you have seen recently across the internet and on the news. If you just focus on the article from the Times in the bottom right-hand corner, that just talks about how next year's holiday market's already become fully booked or getting booked up. And that's really down to the experiences that people have had over the last 18 months, having to look for somewhere to go and visit in the UK and actually finding nice places to stay. People are creatures of habit. They like to go back, so they're rebooking. You've also got the factor of there's around 5 million people in the UK that haven't yet been vaccinated. Many of those won't be vaccinated, so they can't actually travel, or they find it very difficult to travel outside of the UK. So the market's boomed, and it's still booming, and it's staying very, very strong and very resilient. So just talking about some of the highlight figures or facts that have come from the market over the last sort of 18 months. And all of the research that you can see on the screen here is taken from Sykes Cottages, who we've aligned ourselves with for the holiday let market. They're by far the leader in the market. They manage over 19,000 properties across the UK, as well as some in New Zealand, and more specifically 230 units in Devon in Sidmouth, which is a location that we're going to talk about in a bit more detail as we go through the slides. But that's just really pulling out some figures there about how many more Brits are travelling or looking at staycation locations as opposed to pre-COVID. And then more importantly, the rise there in income. There's been a 56% rise in average income across the summer for staycation properties, as opposed to what the income was in 2019. So looking at this as an investment, it's a great opportunity to get into a market that's growing very, very well. So just a quick Google search, and this again is just really highlighting people's activities, people's habits, what people are doing. You'll see there, this just shows you Google searches for the word UK staycation going back to sort of 2016. You fast forward to May time 2020, and you see that lots more people are searching for places to stay across the UK. And that's been down to lockdown, restriction in travels. And as we move into sort of 2022, we expect those figures to keep increasing, where the market's really grown and people are taking a good liking to the market itself. So 2 locations that resonate most to people in the UK are Devon and Cornwall. There's a short video after this slide that goes into a bit more detail on the locations. But they're 2 locations that people know in the UK. They're 2 locations that we've focused on as a business in the UK, and 2 locations that present lots of opportunity. There's been a 40% increase in holiday bookings in these locations since 2019. And more people are likely to look at staycations as opposed to what they were pre-COVID. Again, looking at this from an investor or an investment point of view, holiday let landlords can earn up to 30% more in terms of rental income from holiday let properties. So this is a great diversification option for those investors or those of you that are listening that might already have portfolios. If you don't have anything like this is a good diversification opportunity. Average yields or net yields tend to start at around 7% net. So it brings in a very, very high income. So this is an income generating asset, something that you should certainly look at to build your portfolio. So I'm just going to go into a short video. Okay, so that's a video.
James, as a bit of explanation, there's a little clip in there of Morris dancers. I'm not quite sure if everyone knows what the Morris dancers do, but if you got any more footage of that, I think people would love to see the Morris men. I had a relative that was one. Yeah, I'm going to watch that again because I love Morris dancers. That's great. It's a beautiful part of the country. I know it very, very well. I had my honeymoon there, in fact, but left after 3 days, and then the marriage fell apart. But apart from that, it's a beautiful place. Sorry, I interrupted.
No problem at all. But yeah, look, just you got some valid points there. That the UK coastline is actually beautiful, and it doesn't always rain in the UK. People from the UK love to go on holiday. many people save up for the year to take 1 or 2 holidays, and there's lots of really nice places to go. Stoneleigh Village is one of those in Sidmouth in Devon. This is the opportunity that we have available for you guys. It's 15 units. They're all 3-bedroom bungalows. They're off plan, so they're under construction. They'll complete Q1 2023. The prices there start from £285,000 going up to around about £350,000. And every single unit will have its own outdoor jacuzzi, which is quite important. That elevates the rents and elevates the occupancy rates. They're all pet friendly. So as Paul mentioned earlier, you can put the dog in the car, drive down to the coastline, spend a few days or a few weeks in these locations with your pets. There's parking on site. There's lots of green space. The yields are coming in at around about 7 to 9% net. And the payment plan is a 35% on exchange with a balance on completion. Now, what we've negotiated here with the developer, and it goes down to the relationship we've got with the developer, is the developer will offer a 5-year interest-free payment plan on completion. So for those that are looking for a finance option, they can pay 35% on exchange, 15% on completion, and then they'll have 5 years to pay off the remaining 50% balance. And that's completely interest-free. That's down to the developer being a very strict Muslim, so won't charge any interest. And that's something that we've negotiated with the developer off the back of our relationship with them. So there's a good opportunity there for people that are based around the world that may struggle with mortgages. This is effectively guaranteed, and it's an option that you can take on completion.
Thanks, Jake. In fact, JP's actually asked that very, very question. So JP, I hope that answers it. Thanks. That's a really, really good offer, actually, isn't it? When you think about it, I don't know what it breaks down to. I'd have to work that out. But interest-free, 5 years, that's 60 months. So do you know what the figure is without me getting my calculator out?
There's probably, in terms of your income based on our stats, it's probably, I think it's around a £6,000 to £8,000 deficit, i.e. the income that you get, you top up £6,000 and you've paid that initial first 10% back. And that can obviously fluctuate either way, dependent on what the occupancy levels are and what the nightly rate is. But that's sort of our view. And just on the lending, the holiday sector has always been a strong market, and obviously due to COVID, it's got even stronger. However, the biggest challenge that we've seen over the last couple of years with this type of asset is the fact that not many banks will lend, i.e. a generic mortgage. It's very, very restricted, very tight, hence why we've gone to the developer and said, we know, we love the project, we want to sell these units for you, we want the relationship, we want to make sure that we're with you for the next few years. However, it doesn't matter how much we want it, it's not going to work unless you put a finance package in place. And again, the developer's been doing this for 20 years, significant land bank, and thankfully their pockets are deep enough to be able to finance these post-completion for 5 years. So again, very unique, not readily available in the market, but thankfully we've got that. And every project that we do with him, he will be doing that same finance package moving forward as well.
Yeah, perfect. So just to show you the master plan, the beauty of these 15 units is they're already on an existing site. So there's around 60 units that are built and operational. They're all highlighted in the sort of orangey yellow color. And then the 15 new build units are all highlighted in blue, some of which will have views down to the coastline. But again, to give you an idea of what these look like, these are the existing units on site. So whatever your preconception is of a holiday home, this gives you a good idea. It's bricks and mortar. It's a 3-bedroom bungalow. If you have a look at the top left-hand corner, which is the external image, the new development will all have jacuzzis. Those outdoor jacuzzis will sit just under the pergola, which you can see there in the top left-hand corner. And then if you have a look at the interiors, nice open plan, spacious living, wood burners in there, lots of green space around the units. And again, there's parking and these are pet friendly. Okay, so last slide on this specifically. Again, we've mentioned Sykes. We work with Sykes very, very closely. They've done a full rent appraisal for us for the 15 units. They've used the existing 60 units that are on the site, and they manage a number of those units. And they've been able to give us a very, very detailed example and breakdown of how this is going to look from a financial standpoint. So they anticipate from the 52 weeks of the year, these will be rented out as a minimum of 37 weeks, which gives you a 71% occupancy rate. That generates just under £1,300 per week in terms of income. And then a gross income per year, you're just shy of £50,000. Now, we've looked at this and we've taken out all of the fees. So sites have their own fee, 32%, which you may consider to be high. However, they do absolutely everything. They are leaders in the market. They put these onto the portals, booking.com. They're an award-winning company. They really know what they're doing. So you're paying for a service, which is a very, very good service. If you're overseas, it's very hands-off. So it's very, very recommended that you use them. You don't have to use them, but they are there and we will be partnering with them. We've gone a couple of steps further after taking out their fees. We factor in all of the cleaning costs, changeover costs for bedding, etc., cleaning the jacuzzis, putting a new welcome pack into the properties for every new guest, as well as taking out all of the utilities costs, water, electric, etc. And that then breaks you down to give you a net yield of 7.6 per 2.2% on average. So that's a good working example, and that's a really, really good net return from any property investment. And as we've already mentioned, this is a great diversification product, great for income, and something that investors should certainly look at.
Can I ask a question? If I wanted to go back to the UK and stay there for 2 or 3 weeks, and obviously I own one, do I just pay the normal amount that everybody else is paying, or do I get as it's mine?
Yeah, you can book in. So you can book in and you can either pay yourself or you can have it for free. It's entirely up to you. It all comes down to the income that you get at the end of the year. So yeah, you can book it and stay in it anytime you like.
Whilst I'm on, another question has come in from Linda, the regular viewer. Do you have any projections on capital growth over the next 5 years?
We do, yeah. So we can provide a bit of information on capital growth. The market's seen some very, very good growth over the last couple of years, obviously because it's a booming market and there's limited supply. So there's good capital growth opportunity here as well. It's not just the yield that you're getting out of this.
Yeah, I think an obvious question on that, obviously, COVID thankfully is not going to be around forever. And we seem to be getting to the back end of it. And a lot of common questions on this, is it COVID fueled? I.e. 2 years from now, will there be a market as strong as it is today? And that's what we've put a lot of focus and a lot of work. In terms of capital growth side, I mean, it'll be effectively yield driven. I think this is one of their markets where the price is effectively derived from how strong the yield is, which will keep pushing the prices up the stronger that net position gets. So we've got some good stats on what 5-year growth looks like based on what we've seen over the last 5 years. And then we've been very modest on what our internal predictions are, just because we'd rather over deliver on this and keep more people happy rather than telling them you're going to double your money in 5 years and you don't. So we've been very conservative on our numbers, and everything that we've been through today that we've talked about in this sector, it's all third-party information. It's not Paul or Jake from Global Residential thinking this will happen. This is independently researched stats from some of the biggest providers in the market. There's no bigger than Sykes. And thankfully on this site and a couple of sites that we've got for next year, they've done our rent appraisals already and they'll be working on them. And you look through that cost sheet that Jake just showed you as a snapshot, and the first thing you think, and we all do, is that it looks expensive in terms of the management cost. Because it's so significant. But again, that's where the market is. If you're with booking.com, they can charge up to 19% of your rental amount just to get that client in. And that's no management. That's just literally finding the client. So it is expensive, but it's a service proposition. And as Jake alluded to as well, we should all be focused on how strong that net position is of 7.62%, because they are the real numbers.
Perfect. So just leading into the next sector, Paul, did you want to open up on this one?
Yeah, again, similar to the holiday market, we've been looking at this, but it's never been here for retail investors. It's always been big institutes. And again, when Jake takes you through some of the brands that are heavily invested into this sector are significant, and all household brands that you will know. So we've been working on the same concept. So social housing, government-backed leases, but to make it available for retail clients. And that's been the biggest challenge. Thankfully, we've done that now, and we're with a provider, or 3 providers, in fact, that have a significant pipeline of products. And the opportunity for us with them is obviously we've got footprints and relationships such as Holborn, another financial services business, or all corners of the globe. So that's the interesting factor for the providers, because they want to keep developing, keep building their stock, and obviously sell them on. And thankfully, we've got the opportunity to do that. But again, for retail clients and investment starting from as little as sort of £65,000. Just in this sector, just a caveat as well, is it all cash transactions? We may be able to refinance after completion, but in the short term, because of the nature of what it is and the contract with the government, it's all cash transactions. So no mortgage finance available in the short term.
I think that's important, by the way. And you know, chatting to you just last week and your experience with it so far, people are tending to buy more than one. You know, it's an investment, and people are buying four or five. Is that right? Is that the sort of appetite you're getting?
It is, and that's what it's been. I mean, the 25 we've sold so far in the last couple of weeks, not one person's bought one unit. Hopefully they will start to, because that's the objective for us, to just get people into the sector, you know, one unit or five, whatever it may be. But it's been quite surprising for us. Again, it was our first project we've ever done, so we didn't really know what to expect. But the key thing, and we'll keep talking about it through this presentation, it's just the strength of the lease. That's what people are buying into. You know, let's face it, social housing, so they're not glamorous by any means, and we never pretend that they are. They just fit a massive sector in the market that's massively undersupplied. And thankfully, we've all got opportunity to play a part in that now. And another thing just to add as well, these are ethical investments, which Jake will go through again. I mean, the people that we're affecting the government housing here, the people that, you know, that need housing, potentially on benefits, but they need housing. It's not all, don't mean it in a bad way, but a lot of people think of this social housing as the wrong sector of tenant. But again, the tenant's the tenant, but your contract is with the government, so it's almost irrelevant. And again, you get paid each and every month. There's no service charge, no ground rent. So again, it's net. And there'll probably be a conversation at some point. One of the questions may be, well, again, similar to the Sidmouth question, what's capital growth look like over the next 5 years here? And everyone has a different view on this, but this is not a capital growth play. This is just an exceptionally strong, secure, high yielding government-backed contract, which is what it is. So you're probably not going to double in the next 10 years. If it does, great, but we're not positioning it that way. This, again, strength of the contract, the tenancy contract, and just the undersupply in the market and the strength of that net yield as well.
And you know what I'm thinking? Obviously, we've got a lot of Holborn troops on, and you know, when people do struggle or find it because they're in a certain part of the world, whether it be in Africa or somebody yesterday was in Iran, this is apart from the obvious. This is something that they can look into, get into fairly quickly, no matter where they are. Would you agree?
Exactly. Yeah, it's a straightforward transaction. Obviously, it's UK laws represent the buyers, but as we all know, Chris, and you know, we've obviously worked together for a long time, you know, historically as well, and probably one of the biggest challenges in the residential property sector, and it's not going to go away. We have to deal with it. Is on the mortgage finance. You know, we see a lot of it is challenging. You know, and we do everything we can. We work very closely with IPFG, who are a great firm, and they do absolutely everything they can to get clients mortgage finance. But again, it is a risk. There's down valuations to consider, which doesn't reflect the value of the property. It's just out there and it's not going to go away. So we will always keep doing city centre residential units. I'm not saying we won't, but personally, from a global residential standpoint, I look at this type of product and we're not going to have any issues. There is no financing, there's no valuations. It is what it is. It's just an exceptionally strong tenancy agreement with a housing association that people are going to sit back. You're always going to have a tenant and you'll get paid every single month. So that's how we've looked at this. It's a bit of a breath of fresh air in terms of that whole process, because we don't have them challenges that normal residential off-plan sales give us.
Well, I know Darren's watching and he's sending me messages as we speak. So yeah, I agree with you. He does an excellent job. And I mean, I'm not going to start straying away, but it's true to say you've got other developments in the UK like Bank in Birmingham, etc. And you've got a good one coming up, I know, in Liverpool. But let's not muddy the waters.
We have, and you know, that's very much our bread and butter, and that's what we've done for so long, and that's what we know very well. And the business is built around that. But you know, maybe in the next 5 years we're doing more of this kind of stuff than we are normal residential. Who knows? And that's not a bad thing.
I think for clients as well that need to get a footprint into the UK market, this is a great opportunity. It gives you exposure to the UK. You're then earning some money in pounds. Those that traditionally struggle with mortgages, you know, having an asset in the UK could help them in the future to then buy your buy-to-let investment that we typically sell. So yeah, it's a great opportunity to get access into the UK, and it's great diversification.
That's fantastic timing, Jake. Just got a message in from a guy called Andy Piggott. If I bought a property in social, would it make me easier to get a mortgage in the future? And you answered it straight away. So brilliant timing. And thank you to Mr. Andy Piggott for sending that in.
Perfect. So what you're effectively buying here, just in short, is it's a refurbished property, so newly refurbished, which has a government-backed lease from the Housing Association. And then on day one, when I say day one, when you actually complete on this and take possession, it will start to bring you an income, which will be a fixed income over a certain period of time. That time frame can be anywhere from 5 to 25 years. Yields in this sector range from 5 to 10% net. Typically, the product that we have is around 7% net as a minimum. The investment size can be anywhere from £50,000 for an individual unit up to £10 million. And when you get into the million mark, you're looking at obviously blocks of units. And then the developers that we work with a number of housing association providers, and they're all key providers that have a very good name in the market. The developers already sourced over 2,000 units and rehomed over 1,000 people. Now, the rents are fixed. They're fixed term leases. As I mentioned, typically 5 to 7 years is what we're looking at, but they can go up to 25 years. And it will all depend on whether it's a self-contained unit or a block of units or a house. But what it's providing you really is significant income with exceptionally low risk. And something like this will always perform in an underperforming economy because it's fixed, because it's government backed. There's no changes that can happen to that lease. There's no changes that can happen to that net yield that you're getting. It's all assured. So just going into the demand in this sector, more specifically, the amount of people that need to be housed or rehoused. So that demand's very, very high. There's 1.6 million people on a waiting list. That official waiting list is slightly lower. It's 500,000 people lower, but these are all people that need to be rehomed. Some of these people and some of these families have been waiting up to 2 decades now, so 20 years, to get into social housing. So there's a massive, massive demand, and there's just not enough being built. Last year, just over 6,000 new social houses were built. That's a drop off of 84% since 2010. So it's only increasing, especially off the back of COVID, where people's circumstances have changed, and they've now had to go into the social housing sector to find homes. So the demand's there. So Paul touched on this earlier, and this is a really good point. So who's buying into this sector? It's always been large institutions, the pension funds, the people with the big, large amounts of money have always bought into this. They bought into this sector for a reason. It's very, very safe. You've got a government-backed lease for a certain period of time, and you've got a fixed net yield. So these are just some of the names that have been in the sector for some time now and are heavily in the sector. And you've got the likes of Blackstone, Goldman Sachs and Schroders that have all put a lot of money into this sector in one way or another. So all the big players are inside this sector. That now has opened an opportunity for us as retail investors. I spoke about the demand. There's a huge demand. 145,000 new homes need to be built to keep up with that demand. There was almost zero private equity into this sector in 2016. That quickly increased to just under 3 billion in 3 years going into 2019. So now what's on the table is we've been able to bring what is typically an institutional investment into the market for retail clients. So you've got access to something that you wouldn't normally have access to. And again, it's a great diversification product. If you are a property owner, you do have a property portfolio and you're heavily capital appreciation led, this is something good to have as a diversification. If you're just starting a property portfolio, this is a great product to get into because you can get into it for as little as £50,000. So just an overview, Paul touched on this earlier, but just to recap, so all of the rents are assured. There's no tenant damage or tenant management that you have to pay for. It's all covered by the government-backed lease, so the housing association provider. So if the tenant makes any damages internally, it's all covered by the provider. No lettings and management costs, again, all covered by the provider. There's no void periods because it's a fixed lease. The minimum of that lease will be 5 years, all the way up to 25 years. As I mentioned earlier, every single unit that we bring to market is newly refurbished. and there's no ground rent, no service charge. So your net yield is a true net yield. And then most importantly there, it really is an ethical investment. You're providing housing for someone that doesn't have the ability to find their own home.
Jake, just a quick questions coming from Malaysia from Wendy. Furniture.
Yeah, all
Do they
included.
provide that and damage to furniture? How does that work?
That's all covered. So the easiest way to explain this is the property's newly refurbished. The housing association will take that property on. They'll take a minimum of a 5-year lease on there. Anything internally is down to the housing association to cover. So they need to furnish it for the tenants. They need to repair that furniture if it's broken. If there's any issues with the fridge or the oven or a light bulb going, it's all down to the housing association. So it's as hands off as it can be. There's no additional cost to you whatsoever.
Okay, good. Another question is coming from Russia, from John. Resale after the 5-year period, is it easy to sell them on?
Yes, you own the property. It's yours. You have full ownership of it. What typically happens is 6 months prior to the 5-year lease ending, the housing association will communicate with the owner and offer another 5-year lease. Because the demand's so high, they need this property, they need this housing to home people. So you have the option then of taking that lease on and extending it for another 5 years or 7 years or 10 years, whatever it might be. Or if you wanted to, you can take possession of the property. You can rent it out in the local market if you wanted to, but then it becomes very much more hands-on. You've got to pay your lettings and management fee, ground rent, service charge, if there is any, if it's a flat and it's not freehold. Any breakages are all down to you. So it then becomes very hands-on and the yield gets slightly more compressed. But to answer the question, you can resell this at any time.
That's great. Same question came in from Jason Conlon up in Scotland. So hope that answered your question. And the process, is it fairly straightforward? Is it the same as we're used to? Reservation fee, etc.?
Exactly that. So reservation fee, introduction to the lawyers. The lawyers will then send out contracts. They'll explain the contracts, they'll explain the lease, answer any questions for the client. And then because these are completed units, it's a simultaneous exchange and completion. So the transaction can be conducted very quickly. It can all be done in 14 days, so 2 weeks. So it's very seamless. The only thing you need to consider as an investor when buying one of these is your legal fees and any stamp duty that you might have to pay. So depending on where you are in the world will determine on how much that stamp duty is and whether you're buying it in a company or an individual name.
Okay, so buying in a company name is perfectly acceptable as well. Okay,
yeah,
and we can
definitely
use GetGround for that, presumably. Our
Sure.
friends at GetGround. Jason has just asked another question. Typically, what is the difference in yield between 5 and 20 years?
So typically you're going to get a higher yield on the 5 to 7 year leases. So anywhere from sort of 7 to 8% typically. When you get up to the longer leases, when it comes to sort of 15, 20, 25 years, that lease gets that yield gets compressed. So that's when you start to get down to the 5 or 6%, normally around 5% for the 25-year leases. But yeah.
Okay, that's great. Thank you. Sorry, I interrupted you, but I like to ask questions when they come in because
no, it's good. Yeah, no, it's good. And then there's an example here of what we would typically be offering to our clients. This is a 3-bedroom freehold terrace house located in Bradford, £98,000. This provides a net yield of 7.3%. So that's your net yield, which gives you £7,200 per year. So that's just a good working example of how that looks. The only costs you've got on top of this are, if you're buying it, again, as I just mentioned earlier, legal fees and stamp duty costs. That's everything. And then if you wanted to, there is the option to take an additional insurance for the exterior of the build, which will cost you anywhere between £20 and £30 a month.
Okay, and obviously you've got enough property there for people to tailor what their budget is.
Correct. Yeah. So there's a variety.
And the minimum is, I think Paul mentioned 65.
Yeah.
And what does it go up to as a matter of interest?
For the current availability we've got at the moment, it's going up to around £200,000 to £250,000. However, we can source blocks, so we can get a block of apartments if someone wanted them. We've had a client recently ask us to source a block of apartments with a budget of up to £4 million. So there's plenty out there for us to get access to. It really depends on what the clients are looking for. One thing I would mention is these do move very quickly. They get snapped up very quickly. So the stock availability changes quite frequently, where they're being bought out very quick.
Well, everybody knows my email address, and I'm sure they know yours, Jake, and yours, Paul, as well. But just come through me, or go through one of the guys for an update whenever they want. So no, I think it's a fantastic investment. And like I said right at the beginning of the show, we've not got anything else like this before. So it's great. I mean, we're all going on a summer holiday down to Sidmouth, or we can get involved in social housing and be green and ethical. So I'm really enjoying it. Sorry, I interrupted again.
That's fine. That's fine. That pretty much wraps us up. There's just 3 key features, really, just recapping on both opportunities. So no mortgages for Sidmouth, the holiday let. You've got an interest-free payment plan on completion if you want to take it, which is fantastic. There's no mortgages on the social housing, which means, as Paul mentioned, you've not got the risk of your circumstances changing and not being able to get a mortgage, down valuations, all the usual hiccups that you get with mortgages. It's a quick exchange and completion on the social housing because it's ready and completed stock, so the transaction's quick. The leases on the social housing are long-term and they're fixed, so it provides a secure income. And then with the Sidmouth holiday lets, you've got that uncapped return nature, looking at 7% as a starting price going upwards. And then lastly, I've mentioned it several times now, it's a great diversification tool, moving into a slightly different sector to the norm. It balances your portfolio. And for those that are looking for income from property or income from any investment, these 2 are certainly something that you should look at and consider for sure.
I think it's a great option. The questions are still coming in, but I do think we've covered most of them. And I've really enjoyed that. I think it's great. I've got messages coming on my phone as well. Matthew Hugard is saying, this is great. So he wants to buy half a dozen. So I'm going to incentivize him to do that. Thank you very much, Matthew. But that is great. So just a quick opportunity now, Paul, with Global Residential, what's coming up? What have you got? Can you do a quick 3-minute ad?
Yeah, for sure. Yeah. So we've been waiting on a significant project in Liverpool Waters, which I don't know how familiar everyone is with the Liverpool market, but they're extremely cautious with the planning department now because of some of the errant projects that have gone the wrong way, such as Elliott Group. So they're extremely cautious signing off any new projects with planning permission. So we've been working on with Ramal Capital. It's the best site in Liverpool, and I'm not just saying that, it definitely is. You're right on the water. In my previous company where I was before, we sold the first tower there, and I know there's been another tower that's sold since. So this will be the 3rd tower, water both sides of it, right on the Liverpool waterfront. And it's just extremely frustrating. We keep getting delayed with the sign off on the planning because we know as soon as we get this launch, it would just sell itself, given the price point as well as the location within Liverpool. So we're expecting some good news on that on the 19th of October. And obviously we'll keep everyone fully updated as to when we get that launched. And yeah,
so it'll be Strawberry Fields forever then, Paul.
It certainly will. Yeah, it certainly will. You can do the opening speech for us as well if you wouldn't mind.
And you've got Birmingham as well still. We've got a few left in bank.
Yeah, a few left in bank, completed project. We've got, I think we just sold out our last unit on the jewellery quarter project there, but there's another project we're looking for mid-November. Again, located in the jewellery quarter. We've got a scheme in Leicester that we're quite close on. Looking at 2 in Reading, 1 in Tunbridge, which is quite nice as well. Good accessibility into London. So yeah, there's a lot of things happening at the minute in terms of our product profile. The guy that runs our due diligence for us, Jonathan, if anything gets passed in from a DD perspective, then it's a great project to be associated with. And just to caveat that as well, probably every 10 projects that we look at the minute, 8 or 9 don't even get through, just because of the deposit levels, no security for clients. And again, we've all been in this industry long enough. We know what a negative effect this can have on with clients' portfolios if it's a bad experience. So we're really using all that knowledge, working backwards from that to make sure that whatever we present to anyone, any of our clients, that it'll be a good client journey. We'll do everything we can to make sure that that's the reality. So lots there, but again, up until we've got rubber stamp on some of these, then it's difficult to get too excited about them.
Thanks, Paul. No, let's just stick to what we've got in front of us, and I think they're excellent. Sidmouth and the social housing, very excited. Oh, thanks. Oh, good. We've got a thank you from Ali. Thank you, Ali. This is being recorded and we'll probably going out on the BBC. If not, it'll be on our portal along with other brilliant webinars we've done. Thank you, everybody. Thank you, Jamie. And see you next week where we've got United States of America, greatest country in the world.
Brilliant.
Look forward to it. Thank you, everybody.
Thanks, everyone. Thank
Cheers,
you.
guys.
Thank you.
Really enjoyed that. Thank you.
Thanks.
Thanks, Miltos.